Hello, everyone. Welcome. Wishing you all a very happy new year. So, this is the time of the year where everyone decides on New Year resolutions. So, apart from your personal goals and resolution, one should also set financial resolutions. Financial resolutions are much important because they laid a solid foundation to manage your finances and to achieve your investment goals. So, today we have Atul Karwa from Research Desk who will share some ideas about how to set your financial resolution. So, Atul, what is the most primary thing one should consider in setting the tone right for the financial year?
Well, first of all, a very happy new year to all our viewers. Coming to financial resolution, one of the most basic resolution that one must adopt is save first. The best way to check on your savings is by setting it aside at the beginning of every month. Often what people do is they spend their earnings first and whatever remains is saved. What needs to be done is the other way around. We need to save a fixed amount every month according to one's pay scale and spend the remaining amount. And with an increase in income, the amount set aside should also be increased every month. This simple step will help you in reaching your money goals faster. Another basic rule that one needs to be understood and applied in all our lives is don't buy what you don't need. We need to shop and invest in a smarter way. If you need to buy clothes, bags, shoes, whatever, it makes sense to go for a better quality and a known trusted brand rather than buying low quality cheap products. However, it is important to question whether we really need that super expensive watch in our collection right now. If, as the saying goes, if we buy things we don't need, we'll soon have to sell things which we need.
True, true. Moving on, so preparing budgets is more of a thing that is followed by governments, corporates, and financial institutions and like institutions. So, uh, so why personal budgets are also important, and how one should tackle preparing their personal budgets, and what are things one should consider.
See, why do corporations and institutions prepare budget? It is to have a control on their expenses. In the same way, it is important for individuals to make a budget to have a control on their expenses. This may seem like very hard work, but it is the most efficient way of keeping a track where your money is going. Nowadays, there are various options to prepare a budget online. You have apps as well online. All you need is to provide your information of your income and expenses and your savings. So you need to be reasonably be sure what your income, expenses, and savings are post-tax. If you have a big expense coming in the near term, like a college tuition fee or a renovation house, you can increase your savings and treat the money as spent. Also, we need to avoid too many accounts and credit cards. Many individuals at times open a bank account or take a credit card to get benefits of some of the features. But after some time, these cards are completely forgotten. But all financial products have a charge, have a financial charge. Like for a bank account, you would need to maintain a minimum balance. For credit card, you will have annual charges. So all these can be avoided, and this money can also be saved.
So asset allocation is the heart of financial planning.
Right.
So what are your views on why we have to select the right in selecting the right asset allocation mix, and what's your take on that?
See, there is no one size fits all in when it comes to asset allocation. All individuals have different long-term goals. Their risk tolerance levels are different, and their time frame is different. Therefore, one needs to have a targeted asset allocation that is a mix of stocks, bonds, and cash that aligns with the stated parameters and with which one is comfortable even when there is a downturn in the market. We need to diversify across asset classes and within asset classes also. We need to consider the tax impact and the post-tax returns. And it does not mean that once you have made your asset allocation, that same asset allocation will stick for the life. You need to evaluate your portfolio performance at least twice a year so that you are sure that it is in line with your stated goals. And also one needs to remember that the long-term progress that the portfolio is making towards our goal is more important than the short-term portfolio performance.
True. So also we see that loans, be it your for your house, for uh, auto loans, or maybe for education loans or credit card loans, so they have been totally practically inescapable nowadays. So how to manage your debt levels so that one is not overburdened with too much debt payments, and not overburdened with monthly EMIs.
When we come to debt, it is neither a fundamentally good or neither nor fundamentally bad. It is just simply a tool. For most people, some level of debt, like you said, is a practical necessity, especially to purchase an expensive long-term asset like a house to be paid over time. However, the problem arises when debt becomes the master. Most of your earnings are going to in repaying your debt and servicing interest on that. One should not confuse what you can borrow and what you should borrow. We have to keep our monthly expenses of owning a house as a thumb rule to say 30% of your pre-tax income, and overall debt repayments, including all auto loans or credit cards, education loans, to around 40% of your pre-tax income. One must remember historically the long-term returns from capital appreciation on a house has been lower than returns on a diversified portfolio. And for managing your debt well, you should pay off your expensive loans first, like credit cards, which are phenomenally expensive.
Okay. So financial planning is not complete if you don't account for unexpected events or unfortunate events. So how much funds one should keep as in liquidity as a buffer to manage these emergencies, and how to ensure tackle these emergencies.
The life is unsure for everybody.
Hmm.
There might be any unfortunate event like an accident or some medical emergency. So to protect against that, we need to take insurance. We can protect against large medical expenses by taking a health insurance. In that, we need to take care that the policy matches our needs in areas such as coverage, deductibles, co-payments, and choice of medical providers. We, for protecting against life, we can take a life insurance if we have dependents or other long-term obligations. If we have minor children or other large liabilities that will continue after one's death, so we can self-insure. Also, many corporations nowadays provide insurance to their employees. So, in case that is not adequate, we can go for additional insurance. And sometimes we are faced with an accident and there's a disability. For that, we can take a long-term disability or personal accident insurance. If we see the odds of becoming disabled are greater than the odds of dying young, so we need to get adequate short-term as well as long-term coverage.
So one should be totally aware of where all the investments are happening, be it in equity, debt, mutual funds, or insurance, whatever FDs you are placing. So record keeping becomes utmost important here. And in today's digital age of investing, people are investing more through the online and digital routes. So how to manage that, all the records, and how to keep it safe? So what are your views on that?
Over a time period, there are many investment an individual makes, which are redeemed, which gets matured. But at times, what all investments he has made, he himself sometimes be not aware. So it is important for an individual to make a will. A will is just isn't about transferring assets. It can provide for your dependents support and care and help you avoid the cost of delays associated from dying without having a will. So one must consider storing all the personal accounts and important documents on a portable hard drive. It is also a good idea to have copies of all your investments, certificates, passports, trust documents, records of home improvements, insurance policy, etc., in a secure place. And you need to tell your loved ones and the near ones about that secure place. You can have a digital note of all your investments in a file, and you need to give the access to the your loved ones and
Okay.
dependents.
Okay.
And nowadays, all financial products come with the nomination of beneficiaries or nominees, as you say. So it is important to keep all your make a nominee in all your financial products and keep it up to date to ensure the proceeds of your financial products go to the desired person.
One more thing, retirement planning as a concept is taken very lightly by today's millennials. So, could you just tell us why retirement planning is important and why starting it at a very early age is important?
Retirement planning is important because over the years, as your lifestyle improves, you want to maintain the same lifestyle after you retire, but you wouldn't have that earning power after your retirement. So it is important to plan for your retirement from a very young age so that you are able to maintain the same lifestyle after your retirement. Nowadays, majority of the young workforce do not focus on investing or planning for retirement. They are looking to spend money, they are looking to enjoy right now rather than plan for their retirement. But the reality is, it is never too early to invest for your retirement. For retirement, one thumb rule we can follow is to save at least 10% of your pre-tax income starting in your 20s. And you need to increase it by say 10% for every decade you delay. So like if you're starting for your time planning in your 30s, you need to save 20% of the pre-tax income.
So, the calendar year 2019 has been quite a roller coaster ride. The markets have been quite volatile. So, we have seen that the markets were polarized with few stocks uh, uh, boosting the markets up. So, what were the key learnings we got from 2019?
Like you said, 2019 was a really roller coaster, or you can say a very volatile year. So some of the key learnings from the year were that we have seen a lot of stocks falling phenomenally from their highs in the year 2019. Sometimes low level buying without proper research can lead to further wealth destruction in the equity market. We have seen a lot of stocks correcting by 40-50%, and we think that it's a value buy at this price point. But we have seen those stocks further correcting from the 40-50% corrected levels. So we have to have a proper research before we buy such stocks. And the saying goes, what goes up must come down. Though this idiom came from the physical properties of gravity, but holds true for the equity markets. So during calendar year, we have seen the BSE small cap index rallying by almost 60% against a 23% return on the Sensex. However, in 2018, this rally reversed and the BSE small cap index declined by 24% against a 5% return on the Sensex. So all in all, the stock market is like a pendulum which keeps fluctuating around fair value. And one needs to understand the business model and its fundamentals before investing in a stock. This is important because whenever there's a correction in the market, companies with high debt or low level of resources are impacted the most. Therefore, one should always avoid such companies. We have seen in 2019 many companies impacted because they had high levels of debt, and due to the liquidity crisis, they were unable to raise resources. So such companies should be avoided, and we shouldn't put all our eggs in one basket, as the saying goes. Diversification is the primary means of avoiding or managing risk by mixing your investments in equities, gold, real estate, bonds, etc. So diversification helps in minimizing risk of loss by reducing exposure in any one area, thereby lessening the impact of any downturn. Another important point, one should always keep investing in fundamentally sound companies in a staggered manner for the long term to benefit from volatile market conditions.
So, thanks a lot, Atul, for your insights on how to set your financial resolutions. So, once again, happy New Year and happy investing.
Thank you.